In general, it remains a very challenging time in supply chain and logistics, and I think the general feedback I get from players in the sector is it's really not getting any easier to make a dollar. There does remain weakness in a number of sectors, and certainly the drag on the mining states from the downturn in resources and oil and gas is certainly the biggest story that's out there. And that's not just those who are operating in those states. Anyone who transports products into those states are certainly seeing depressed volumes, creating a fair bit of surplus capacity in the market, and that surplus capacity is putting a lot of pressure on prices. But it does depend on what side of the fence you sit on, which I'll touch on in a moment. I noticed in Alan's sector graphs earlier, wholesale, retail, manufacturing, they were all certainly weaker than some of the other services sectors, which aren't heavy users of logistics services. So for us, the core drivers of activity in the sectors still seem fairly soft. And those fairly crowded and sought after markets around contract logistics, express line haul, parcel delivery, freight forwarding, they're certainly as tough as ever. The 3PLs I think that are doing well are the ones that have niche opportunities or in markets where there's the opportunity to add value through differentiated offers or consolidated offers. So there are some who are doing okay, but across the board it is pretty tough. As I was saying before, the nature of the challenge depends, I think, on what side of the fence you sit on. So if you're a supply chain manager, some of the fundamentals aren't bad. The good news is that wages growth is fairly low. So if you were paying 3.5% to 4% a few years ago, you're probably in enterprise agreements looking around the 2% mark. Fuel prices are at relatively low levels. The industrial property market's pretty soft in a few states. So for those who are fortunate enough to have leases that are finishing up, there's reasonable incentives to lock in new agreements. And cost of capital is fairly low, but I think that's if you can get your hands on CapEx. So one of the current challenges I see for supply chain managers is really that a lot of companies are cutting back on CapEx. They're really looking to pull back and preserve cash. So for supply chain managers who are looking for improvement projects, particularly projects that have an element of risk around them, such as automation, I think it can be a little bit difficult in terms of getting their hands on some of that CapEx as well. But if you are a supply chain manager who outsources any component of your work to 3PLs or other players in the industry, that's where that pressure on pricing is coming in due to the surplus capacity that sits in the market. And that's where the other side of the fence, the logistics players, is probably a bit of a different story. So it's important to note that in this industry, it's pretty much, still remains a very fragmented industry. There are very low barriers to entry, and there's often a relatively low level of differentiation between the players. So essentially, a lot of them are out there competing on price, and that's a large reason why you see fairly average single-figure returns in the logistics industry. And the operators who ultimately end up holding those assets often have a fairly high degree of fixed costs, so it becomes a volume game. And as soon as you start to see volumes drop off, surplus capacity creep in, a lot of those hard-fought gains start to get eroded. Those average sort of single-digit returns can slip pretty closely into the red. It's also important to note that when we're talking about the operators in the 3PL space and compare them against the supply chain managers, so yes, fuel prices are down, but for a lot of 3PLs, they pass that back to the customers in fuel levies, where wages are down or there's other factors that are benefiting them. Often when it comes to rate increase times, they've got rise and fall agreements, which means that effectively the rate increases they're getting are barely more than the cost of the actual increases. A lot of companies have a lot of equipment finance, so when the surplus capacity comes online, the opportunity to actually downsize, but the market for second-hand assets is really poor at the moment, so that's putting more pressure on them. And there's this ever-increasing expectation around technology investment and the ongoing costs of compliance. So for the 3PLs, there's certainly a fair bit of challenge on that side, but that surplus capacity issue is the real story because there is an increasing pressure on rate downs, particularly from some of the larger or more sophisticated customers. And where, again, it's a volume game, those 3PLs are wanting to hang on to that volume. They don't want to let it go, and they're feeling a lot of that pricing pressure and having to discount to hold on to that work. So I actually think the often unspoken about issue for the industry is really the financial viability for a number of small to medium-sized players and for supply chain managers just to make sure that the solutions they have in place are going to be robust over the short to medium term. I think a lot of people sort of think, oh, well, if the smaller guys fall by the wayside, who really cares? Because we've got the larger guys, they dominate the market. But the top 5 Australian logistics companies only make up about 15% of the market. So there is a very long tail, and there is a heavy reliance on the second and third and fourth tier players in the market. So I think it's going to be continue to be tough for a while yet in the sector. And there are going to be a few, I think, who at the end of the day probably don't make it. But it really does depend, as I say, on which side of the fence you sit on. For the supply chain managers, there's probably a bit more upside than some of the 3PLs. The other thing is, I think in terms of potential consolidation in the market, Cube have been busy in recent years. I suspect they'll have their hands full for a little while, given what's just occurred with Patrick. I noticed Toll earlier in the year were talking about potentially looking at some acquisitions now that things have settled down after the acquisition from Japan Post. And I think that's probably a signal that, again, that organic growth just isn't there, so looking at growth through acquisition. I suppose the final point I'd just make is it does remind me a little bit of when I was preparing for this, a well-known logistics identity who I won't name, who made quite a bit of money out of the sector, and his last recent forays maybe hasn't gone so well, was on a panel like this, and he was asked the question about why he continues to invest his personal wealth in transport and logistics. And after pausing for a couple of seconds, he said he thought it was just a general lack of intelligence. I don't think it's as bleak as that, but it's not for the faint-hearted, and I think the next couple of years is still going to sort out the men from the boys.